This is the Friday, January 13th, 2017 version of the Market Plus segment. Joining us now is Brian Roach. Brian, welcome back.
Thanks, Mike.
Brian, it is Friday the 13th. Are you traveling today?
I didn't realize that until you just said it.
All right. Well, I apologize then for bringing it up.
The answer is no, I'm not.
Perfect. All right. We've got a bunch of questions from our Facebook and our Twitter followers. I want to kick it right off here with a good question from Chad in Dunbar, Nebraska. He says, I sold corn in December, but did not buy back calls. Would the early February low be a good time to buy calls?
I think so. Let's just assume that the trade plays out like the last couple years. We've had a low come right ahead of the U.S. crop going into the ground, and I call that the hedge fund manager opportunity, because they approach the corn market in the U.S. like it's perfect until proven different. And so if you ask yourself, have you ever lost a crop in March? No. April? No. And so the hedge fund guy, I think, looks at it like the crop is perfect and approaches it that kind of same way. So if we were to get that sell-off on into the front part of the growing season, first of all, I don't think it'll be the kind of sell-off we saw last year because of the acre scenario. So if we get an acre scenario that plays out through the March planting intentions like last year, then I don't think we probably see as big a low. But somewhere in here before the U.S. crop goes into the ground, I think you ought to buy it, yeah. Okay. That's where I would do that.
What about soybeans? If I've been selling old crop beans, I was selling old crop beans before the end of the year, didn't buy back any calls. Is it worth doing at this point?
Well, it's a weather trade, really, Mike. And so I think that maybe perhaps there's not as much upside in it after like yesterday's move, and certainly after the buck 30, 35 move we saw late last year. But I think that, if you look at the bean market over the last 4 years, we've seen a $1.80 to $3 move each of the last 4 years. And if I were to look at that this year, and over in corn, it's been something like 80 cents. All right, so the way the market's set up today, I would think that the bean variation or the upside in bean may be smaller, okay, and although that might not be true, and corn would have actually greater potential because corn demand, and I call that the sleeper side of the corn market, is that demand is extraordinary high.
And you touched on that on the program. You talked about how this last week we saw incredible ethanol production,
correct,
as well as a stocks drawdown. But then we also had, towards the end of the week, Thursday, I believe, China come out and say, hey, we're going to tax you 50% on DDGs coming into the country. We're also going to put that tax on ethanol back up to 30%. How much of a damper is that going to put on that ethanol production?
None. I don't think at all. I think that, yes, they've been buying it, but the bigger opportunity has been in Brazil. Brazil has been buying a lot of U.S. ethanol, and the sugarcane problems they had last year, I think that looks really good for this year, and that's part of the reason why ethanol has been running so strong. So for the minute, I don't think that becomes a big issue at all.
Okay.
Yeah.
Might provide maybe a buying opportunity for U.S. cattle producers on the DDGs if we're
certainly
not moving to China.
That's true.
All right.
Absolutely.
Next question from Vance in Nebraska. He's on Twitter at Proverbs2_6Dad. Why, when soybeans are priced at profitable levels, do many, not all, discourage selling a high percentage of production? As we look out to that November contract, if we can lock in a profit, how big of a percentage should you be locking in?
Well, it differs for everybody, and so I would be reluctant to put a number out there, but let's just say what we have been thinking is we would be half sold of 17 production before we get into the U.S. growing season, because I don't want to have all my dice set there for price action tied to the U.S. weather. Perhaps we don't get the scares that we've had like in the last few years. So we've been thinking that it's often that the December-January trade action in beans can bring the high. It's just a seasonal part of it, and so that's why we've been willing to sell, that 10 to 12% of production increment in November, December. Why I think that it'll make some sense here at the turn of next week, and that ought to get us upwards of half of our pre-harvest sales knocked out. And so that's kind of what we're thinking, and that's going to differ for everybody, but you take it and apply it to your own scenario, I think that would play out.
Now, when you're thinking pre-harvest sales, when you're looking at 50% of projected crop, are you basing that on 50% of your total assumed projection, or are you looking mainly at insured bushels through a crop insurance program? how do you decide what your expected production is going to be?
You know, everybody's buying a different guaranteed level of insurance. So, different growers are more optimistic about their APHs than others, and so there's a lot of moving parts in that equation. But
okay.
I would say just look at your total production.
Okay.
But also look at how many bushels you feel like you have to sell before harvest for storage and or cash flow reasons. And the real objective here, and I've been talking about this all week with growers, is to try to get as much of your cash flow accomplished, those sales accomplished, at these higher cycle highs during the crop year. So December, January are oftentimes where you can get that done, and then of course as we come into the major part of the U.S. growing season, that'll also be an opportunity. But the idea is to try to get as many sales as you can get booked to cover your cash flow, such that you can come around and do that a year from now,
right?
And try to not sell on the lower on the breaks. That's
selling
kind of
when you can, not when you have to, at a low for cash flow needs.
Makes a big difference, and you know, we've been improving our selling system, looking at more indicators to build the confidence in the selling decisions that our growers make.
Okay.
And we've adjusted that quite a bit. We think it'll be a lot simpler to look at sales and decide how confident should I be.
Okay. Our next question is from Janine in Illinois at agnews_auto. Janine wonders, when we look at this ag market from a global perspective, is Russia and the Black Sea area taking over as wheat grower for the world, given the acreage numbers we saw today?
Certainly they have an advantage. They have a logistical advantage. They have a cost of production advantage. With the stronger dollar being up against upwards of 80% of our production, and what I mean by that is that we ship a larger portion of our wheat crop than we do, say, corn or soybeans, and so the dollar and the currency equation is tougher on the wheat. And so I don't know that I would say Russia's taking over, but they're certainly they're a more competitive supplier than we are for the minute.
Okay. And you expect that to continue? I mean, as we look ahead, we do anticipate future interest rate hikes. That dollar's probably going to stay relatively strong, in your opinion?
I think so.
North of 100 on the index?
Yes.
Okay.
Yes. I mean, you know, we have to see what Trump's organization really has in mind for policy and et cetera, but I do think that the economy is going to roll relatively strong, and that'll keep the dollar at a higher level compared to other ag currencies in the world.
Okay. Our final question here is from Philip in Ontario. He's on Twitter at Agrodome. He says, we've got the lowest winter wheat acreage since 1909. How does that boost corn and soybean acres in 2017?
Well, a lot of the bean acre increase will come from the fringe states. If you talk to growers in the I states, et cetera, that's not really where those bean acres are going to come from. Maybe some corn on corn gets unwound, and that will fold into a bean rotation. But for the most part, these are fringe states that are making up this larger bean acreage scenario. So I think that, you know, at the end of the day, weather will determine exactly how many beans are planted. Personally, I like the idea that the trade is talking about such big deviations from last year, because it'll probably drive volatility. We all need volatility. We need fund flow. So I think for the minute, though, we just let the weather play out, and we let the farmers are going to get surveyed here in, you know, just a couple months about their planting intentions, and we'll get a better idea of that. But for the minute, we'll just let it play out.
All right. March 31st, planting intentions, Brian Roach. Do beans come in on an acreage basis over or under 90 million acres?
Just under.
Just under. 80, 88, 89?
You're right.
All right. Finally, for our question of the week, each week we like to ask our analysts to define certain terms and explain concepts in the commodities trade. And for a lot of our producers, they are cash grain growers. They're growing corn, they're growing beans, they're growing wheat. To sell for cash, love to see the higher prices. You know, miss 2012. Our question of the week for you is, who benefits when corn and soybeans are lower? What's the flip side, and what are the benefits of lower corn and soybean prices?
Well, if you look at your feeder cattle guys, for example, they finally, with higher futures prices, they're finally able to turn a profit with low prices. But if you look at the intention of the cattle herd, hogs, look around the world, the livestock numbers are beginning to inch up. And so the low prices begin to feed into profit margins that allow reinvestment and confidence in growing the animal consuming numbers. So look at it that way. So I think it's really on the baseline, it goes into that. Certainly we need the retail side in meats to perform, but I think for the minute, you have to look at the increased animal numbers as a reflection of low prices.
And it's no coincidence that ethanol production was so high this last week with corn prices in here where they are.
Absolutely. You know, I think that, you know, ethanol's real story has been tied to steady U.S. gas use and steady exports.
You bet. All right. Well, Brian Roach, thank you so much for taking the time to join us this week.
Thanks, Mike.
Join us again next week when Angie Setzer joins me at the new market-to-market table. Plus, we'll look at bridging the gap between rural and urban America via the tourist trail. And if you find value in our work, please consider clicking the Donate Now button on our website. So until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.